On the 16th of May, an alarming warning was issued by US Treasury Secretary Janet Yellen, emphasizing the urgent need for Congress to raise or suspend the federal debt limit. If this critical measure is not taken, the US Treasury could exhaust its cash reserves as early as June 1st, pushing the United States perilously close to the brink of a catastrophic debt default. Such a scenario would trigger an unprecedented financial and economic crisis of colossal proportions. Simultaneously, a report unveiled by the Federal Reserve sheds light on the pressing safety and solvency risks faced by U.S. banks. Astonishingly, more than 50% of banks are currently grappling with significant losses. The catalyst for this distressing situation lies in the tightening of interest rates, which has resulted in a dire scarcity of U.S. dollars. Offering insight into the severity of the banking crisis, Dimon, the CEO of JPMorgan Chase, expressed his belief that the turbulence in the U.S. banking sector is far from over. He predicts that credit conditions will only exacerbate, amplifying the shortage of U.S. dollars and intensifying the existing challenges faced by banks. However, it is not solely the traditional banks that are teetering on the edge. Low-risk-bearing shadow banks in the United States are also confronting the imminent threat of a financial crisis. The looming specter of a U.S. debt default, coupled with the tightening of credit, is set to pose substantial hurdles for businesses seeking access to financing. Consequently, this will exert a profound impact on economic growth, consumer spending, and consequently, the revenues of both the U.S. Treasury and the Federal Reserve. While the economic and financial risks spawned by a U.S. debt default and a banking crisis are undoubtedly daunting for the United States, their repercussions will inevitably extend beyond its borders. Countries with a single economic structure and relatively fragile foreign exchange reserves, such as Lebanon, the Czech Republic, Poland, Pakistan, and Egypt, among others, will bear the brunt of these repercussions. These countries now face a daunting dilemma characterized by a shortage of dollars or rising dollar funding costs. Their economies have already slipped into a fragile state of currency depreciation and debt crisis. Regrettably, the Federal Reserve is poised to transfer the risks of high inflation and debt default to these vulnerable economies, continuing to exploit nations grappling with evident structural and financial debt issues. Vietnam, with its questionable investment market and a rapidly deteriorating economy, stands as a poignant example of such exploitation. The recent collapse of the Vietnamese economy and export market underscores the persisting impact of the ongoing U.S. harvesting cycle on global markets. Vietnam finds itself engulfed in a turbulent period marked by a significant decline in exports, dwindling investment, and a mass exodus of capital. The country, heavily reliant on exports, has been dealt a severe blow by the prevailing global economic downturn, rendering it an unfortunate harbinger of the direction in which the Asian supply chain is heading. Consequently, Vietnam now confronts the grim reality of regression. The decline in Vietnam's exports has been nothing short of dramatic. In the first quarter alone, exports plummeted by a staggering 11.9%, with April witnessing an even deeper decline of 17.1% year-on-year. Imports have also suffered, experiencing a 20.5% decline during the same period. As a direct consequence, Vietnam's gross domestic product growth rate has dwindled to a meager 3.32% in the first quarter, a far cry from the expected 4.8%. Compounding Vietnam's economic woes is the turmoil plaguing its real estate market. Stringent anti-corruption measures have triggered a liquidity crisis, leading to the suspension of operations for over 1,800 real estate companies in the first quarter alone. The reverberations of this crisis have rippled through the industry's supply chain, resulting in a 0.4% year-on-year decline in Vietnam's industrial production value in the first quarter. Consequently, Vietnam faces a myriad of challenges, including declining exports, weakened investment, capital withdrawal, and a full-blown crisis in the real estate market, all of which cast a cloud of uncertainty over its growth prospects. One of the key factors fueling Vietnam's economic downturn is the decline in investment. For instance, in the first quarter of 2023, Korean companies reduced their investment in Vietnam by a staggering 70.4% compared to the previous year, amounting to a mere $474 million. This significant decline underscores the growing inclination of international capital to exit the Vietnamese market. Foreign investment in Vietnam has plummeted by a substantial 38.8% year-on-year, with over 98 trillion Vietnamese dong being withdrawn from the country. Vietnam finds itself grappling with a host of complex challenges, including declining exports, sluggish investment, and a real estate crisis. These factors have exerted a considerable toll on the country's GDP, resulting in a reduction in international investment that threatens to persist as sensitive foreign investors silently make their exit from Vietnam. Despite having achieved impressive economic growth in recent years, primarily driven by the accumulation of risky loans and external debt, Vietnam now finds itself entrapped in a dollar debt trap. In a desperate attempt to engage in quid pro quo with Wall Street groups, Vietnam's foreign exchange reserves bear a staggering burden of external debts amounting to nearly 70% of its GDP. As of May 1st, Vietnam's total debt has increased by a substantial 9.42% compared to the end of 2022, with credit growth reaching 12.4%. Startlingly, Vietnam's total debt now stands at approximately $172.9 billion, while its foreign exchange reserves hover around a mere $83.6 billion. This staggering statistic paints a grim picture, indicating that Vietnam's total debt accounts for a staggering 174% of the country's foreign exchange reserves. Unfortunately, Vietnam finds itself ill-equipped to address the risks posed by the ongoing U.S. economic harvesting. Its foreign exchange reserves fall woefully short, leaving the country vulnerable to heightened market volatility and the squeezing out of international investment. Moreover, Vietnam now contends with an array of unfavorable conditions, including lagging infrastructure, capital outflows, rising financing costs, and supply chain difficulties in securing raw materials and commodities. These adverse circumstances threaten to exert far-reaching effects on Vietnam's recovery pace, inflation, and the viability of numerous Vietnamese businesses. The vulnerability of Vietnam's economy is glaringly evident as it endures intense fluctuations triggered by oil price shocks, surging U.S. interest rates, and currency depreciation approximately every 10 years. Despite its labor force advantage, Vietnam's manufacturing sector remains nascent compared to other countries, heavily reliant on low value-added manufacturing as its economic backbone. Furthermore, Vietnam's external dollar debt burden, substantial dependence on foreign capital, and an agriculture sector accounting for 30% of its GDP exacerbate its vulnerability. While the Vietnamese government approved an investment cooperation strategy document in 2021 to 2034 to attract high-tech and high-value-added investment projects, progress has been slow, and the regulatory framework remains imperfect. Escalating land prices, consumer prices, and reliance on foreign markets for raw materials have resulted in annual labor cost increases of nearly 10 to 20%. Additionally, it takes several years to recoup investment costs and construction expenses, further eroding profit expectations for businesses. In an era characterized by mounting economic uncertainty and rapid information digitization, the sustainability of Vietnam's economic model stands on shaky ground. This fragility will inevitably impact the investments of numerous foreign companies in Vietnam. A former director of the Price Market Research Institute at the Vietnamese Ministry of Finance emphasized the prevalence of ineffective growth in Vietnam, where quantity takes precedence over efficiency and quality. Consequently, the country finds itself ensnared in a dollar debt trap, while some Vietnamese companies with dubious credibility face the imminent risk of being harvested, particularly within the real estate industry. The credit risk exposure of Vietnamese companies is also becoming increasingly apparent. Should the export industry, which serves as a vital support for Vietnam's economy, continue to experience prolonged collapse, the country may face a protracted recession spanning 2 decades, further widening the gap between Vietnam and its global counterparts in the manufacturing sector.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.